Hi, this is Mike Larson from Money and Markets TV. Lately the so-called experts on Wall Street and CNBC have been completely obsessed with the question of whether the Federal Reserve will wave its magic monetary wand again. They've hung on every word of Ben Bernanke's testimony yesterday, even though he basically said nothing. And if you want to hear my answer to their big question about Fed policy, here it is. Who cares? That's right. U.S. and European policymakers and their decisions on interest rates are becoming increasingly irrelevant. To help explain my point, I want to show you a chart of the yield on the 10-year U.S. Treasury note. It's been trending steadily lower for months now, recently hitting a record low of 1.453%. 30-year fixed mortgage rates are also at their lowest levels in history, meaning home financing has never been as cheap as it is now. So is the housing market booming? No, far from it. In other words, we have the lowest long-term government borrowing costs and the lowest long-term mortgage rates ever. But neither the U.S. economy nor home sales are surging. So why would even lower rates matter? I predict that they won't. But I'll even go one step further. Even if we do get QE3, it might not lower interest rates at all. The Fed itself admits that quantitative easing is having less and less impact on the markets. In fact, a recent study found that QE1 lowered long-term rates by 100 basis points, or 1%, but QE2 only caused them to drop by 14 basis points. That's an 86% decline in effectiveness, and it's a good bet that any QE3 program would be even less effective. Fed's policies had diminishing returns in the stock market too. QE1 brought about a large, long-lasting rally because it was a new policy that shocked the markets. But QE2 prompted a much smaller rally, which lasted for less time, and which completely fell apart in just 2 weeks. And what about all the chatter coming out of Europe? Will Germany back Eurobonds or won't they? Will the bailout funds be able to directly capitalize banks or only lend to governments? Will we get another LTRO program from the European Central Bank? Again, I say, who cares? European policymakers have already tried virtually everything to prop up their economies, their banking system, and the capital markets. But nothing has worked. The ECB even admitted this week that it has no silver bullet solution. The Wall Street economists and money managers know it too, but they're still grasping at straws, hoping for something, anything that's going to bail them out of their losing positions. But the truth is that the only real long-term solution is a period of deleveraging, slow or no economic growth, and falling asset values. That would allow the global economy to purge the excesses of the past several years of bubbles brought about by too easy money, and allow assets to reset at levels attractive enough for bargain hunters to start buying. Of course, we may get short-term rallies from time to time, but I still think your best bet is to take profits and then add downside hedges. And if we do get a sharp rally brought about by the misguided notion that more QE will actually work, sell into it. I'm Mike Larson for Money and Markets TV. Thanks for watching.